Thank you very much. Good afternoon to the small business sector in Glendale and to anyone that will be listening to this presentation today. First, I want to thank the City of Glendale Economic Development Division for giving us the platform for Synergist and me, Eddie Sumar, to be able to share with you a very important subject, mastering financial literacy. This webinar today is the fifth in the series, and the good news is the previous four sessions were already recorded. So if you haven't listened to any of them, the Economic Development Division will be sending you, the team, some of the links so you can freely listen to them. And we hope that all of you can listen to all six, because today is the fifth. There will be a sixth on June the 18th. And then there might be some good surprises for those who listen to all the recordings. There might be one-on-one consulting that we can be engaging with you so we can level the playing field. Small businesses, we believe, are the backbone of the city of Glendale. And I love the title of these webinar series, Let's Grow Glendale. Because remember, a tree didn't happen overnight. There was a small seed that became a mighty tree. And today we are going to show how that mighty tree can stay mighty, or that small seed can grow with a plan, with a vision, with a focus, with a mission that is going to be sure and that is going to be sustained and that is going to be safe and secure. Because financial literacy is a key component in a small business journey. Many small businesses will wake up one morning, the founders will wake up, they see a need, they see a pain point, they look at a problem. Now they want to fulfill the need, alleviate the pain, find the solution. They invest their money, or they seek some money from investors, friends, families, crowd investing, and then they open a business. But sad to say, a lot of the new business fail in the first year. Even within the first 3 years, more than 90% of businesses are already out of business. The goal is not to start a business and to be out of business. The goal is to start small and to become a mighty business. So today we're going to be learning a special skill, the skill of financial literacy, to unlock the secrets of the key financial statements. And one tool that I want to share towards the end of the presentation is effective collections. You'll be surprised how many people can sell. It's easy to sell, but can you turn that sale into cash? Because a sale is not a sale until the cash is in the bank. Now let's start first by ourselves, because I love this quote by Sir Edmund Hillary, who conquered Mount Everest. He was the first one to be on the top of Mount Everest, and he said, "It is not the mountain we conquer, but ourselves." So small business, really, they have mountains of obstacles. But the most important one is the founder, the owner of that business, the CEO of the business who started that business. Many times what we do, we wake up in the morning and we start fighting fires. I want to congratulate all of you for being here today, because sometimes fighting fires will exhaust you, will burn you out. But what we need to do is take time out to seek the important things. The important things allow you as a business to think, to plan, to strategize, allows you to look at the big picture, allows you even to take time out of your busy schedule and to relax. Is really like any human body. We wear and tear during the day, but at night we repair. So being on this webinar for this few minutes, 90 minutes or less of your time today, will allow you to repair your business plan, to repair your vision, so to speak, of your business. Make sure that there are no blinders. So really, you are conquering yourselves by being here, which is amazing. You now have better vision. You're on the top of that Mount Everest that you conquered. Now you can have a clear view of your surrounding. You can see clearly what's lying beneath. So now, as business owners, one thing I like to say it's not just your vision and mission of your companies that matter. I want you to think about your own personal dream, because I believe a business owner, a CEO of a company, an employee in a company, all have personal dreams. But all of them also, all of us have professional vision. Are we aligning the two? It will be a travesty that we work 24/7 for our own companies or for someone else's company to retire and feeling that we have achieved nothing towards our personal dream, our own families, and leaving a legacy. So I like to really balance the two. When we work for a company, whether it's our own or someone else's, are we achieving our personal dream? Are we achieving our professional vision? So financial literacy and financial freedom will keep us alive. We'll keep that dream alive. We'll keep that professional vision alive. So what I like to start, especially if you are self-employed, if you are a small business, probably you started with your own money. The same principles will apply in your personal budget or in your business budget. Are you keeping more of what you earn? As a human being, you get a salary. Are you spending it all or saving some? As a business, when we look at the balance sheet, there is a section there we call stockholders' equity. And one part of that stockholders' equity is called retained earnings, which means when you make profit, are you just spending all your profit, or are you retaining the profit to grow your capital and retain that capital in the business to help you grow? Our goal today is individually and as a business to really become financially free and fully dependent on ourselves, and leveraging the power of what we call leverage of debt. Because when you have money, the banks would like to lend you, and at a very low rate. But when you don't have money, they might not be amenable to lend you because they think you are a risk. And if they do, they want to charge you higher interest rate. So understanding the power of financial literacy, if you are strong individually in your finances, you will be strong also in your business, because those habits will transfer from your personal life into your business life. Again, like any business, think of a business as a living organism. You yourself, we are living organisms. Think about you as a person. Why do you need financial freedom? Why do you need to be financial literate? In order to self-actualize, in order to really fulfill your physiological needs first. Think about it. You can be a happy and successful business person if you are not healthy. If you are not eating, drinking, breathing, sleeping, having good shelter, we cannot function as good managers, as good CEOs of companies. Safety. Are we taking care of our financial security? Because when we talk about safety, is protection from danger, discrimination, and even from unemployment or from not having a business, so to speak. Social needs. Are you fulfilling your personal social needs? Need to belong, to be part of a group? In a business, we can say to be part of an association, to be really part of the economic development division. How? By participating into the activities that the City of Glendale Economic Development Division is putting on to help you as a small business to grow. That's part of your social means your networking ability. See, I'm trying to show you, in the social way, we want to belong. In a business way, we want also to belong to the community that we serve, to the business agencies, to the public agencies that they serve that community. Are you connecting with them? Being on this webinar opens the door to other services that the city could be helping you with. What about self-esteem, status, knowledge, self-confidence, self-esteem? In fact, when you belong, whether in a personal level or in a business level, you build your reputation, you build your character. Think about it. A business of good reputation and character will be loved by lenders, by financial institutions. As a human being, status, character will take you forward. As a business, reputation, branding, good name in the community, build good character. Character is one of the C's of credit. And ultimately, as a person, you want to self-actualize. As a business, you want to achieve your vision through your well-planned mission. So in reality, when we look at financial literacy, whether as a human being, as a person, or whether as an entity, as a business, we all have needs, wants, and desires, dreams, and visions. Make sure, as a human being and also as a business, focus on the needs of the business. Focus on your needs. I believe physiological needs, safety needs, and social are really the big bulk of our needs. Every human being needs that. Self-esteem, self-actualization fall into wants and desires. When we self-actualize, that's our ultimate dream and desire. That's the vision of the company. And usually a vision is for the long term. No company wakes up a morning, or CEO of a company says, where am I going to be in 20 years? I'll be today where I want to be in 20 years. No, you set a vision, a path for the company that is long-term, but you take shorter steps, step by step, to reach that 5-year mark, 7-year mark, 10-year mark, 15-year mark, 20, and so forth. That's how companies build their reputation and their legacy. And that's how also individuals build their legacy and become self-actualized, by taking small steps toward the ultimate dream, and companies toward the ultimate vision of that company. So now let's unlock the secrets of key financial statements. I wanted to set the stage first that companies are made up of people. If each individual that makes up the composition, the structure of that company is good, healthy, because physiological needs, that means we have good, robust, healthy workforce. If everybody feels secure in their employment, if everyone feels that they belong to their department, to their role, to their team, to the company, everyone is leading self, leading the team, and leading the company. Now we can lead our customers to buy our product, to have goodwill and loyalty, and ultimately we will self-actualize. In order to help you to have the big picture, we have what we call key financial statements. But before we go there, I want to give you another perspective. Why do we need these financial statements? Because when you need money, as companies grow, they need access to capital. They need lenders. They need to borrow. They need investors. So what are they looking for? The investors, the lenders, and so forth. They look to satisfy 3 questions. Why should we invest in you or lend you the money? Why do you think that the market will buy your product? At one point, will you be able to turn a profit? Especially if you are a startup. If you are already an existing company, they're going to see, are you sustaining your profitability? Are you growing as a company? Is your portfolio, your customer portfolio, growing, or are you shrinking? Are they of high quality or poor quality? Yes, you might have 1,000 customers, but are they all buying from you? And are they paying you for what they bought from you? These are basic and fundamental questions that lenders and investors are going to be looking at. So what else will a lender look at? If you are a small business and you want to grow your business, sustain growth, and be economically free, so to speak, they are going to look at your profitability. They look at your income statement. Yeah, you sold, but are you profitable after paying taxes? Do you have good credit? What about, are you taking loans and are you paying on time? Are you liquid? Do you have enough cash to pay back all your obligations and your debt and still retain more capital and grow that business? Do you have collateral? Can you show assets, financial assets, real estate, etc., that the lender can say, wow, you really build your company. You accumulated wealth. You accumulated collateral and assets. Therefore, you are credible as a company. That's why when you go to get a loan, they need you really fill out a credit application, a loan application, and you authorize the lender or the creditor to get your credit report. So they want to know your history, your paying history, your behavior in the business world. Are you going to be a good risk or are you going to be a bad risk? What are the statements that lenders are going to be looking at? Any accounting course, any finance course will tell you that they will be looking at three key financial statements: the income statement, the balance sheet, and then the cash flow statement. Now, let's delve into these statements. Like when we think of the income statement, I call the income statement the heart, because that's where really the circular system. If you don't sell, you're not going to get cash. You have to sell first to make a profit. You buy product, you're expending cash. You sell that product, now you're able to generate the cash. But how are you going to generate the cash? First, you have to deduct all the costs against that sales revenue, that the gross sales. Notice here, many times you will see in income statement, gross sales minus returns, allowances, discounts equal net sales. I love to see that your gross sales always equal your net sales. So that means you haven't given discounts. If you do, do it before you book the sale. Do it in the negotiation part. Because if you are giving discounts, allowances, and deductions after the fact, that means something went wrong. Maybe you sold the wrong part, but you don't want to get it back. You want to give them a discount to keep it. Or there was some defect. Just deduct from the payment and pay me the rest. Don't do that. Make sure that every sale is of high quality. Every negotiation was complete, so your gross sales will equal your net sales. That is the source of your gross revenue. Minus the cost of sales equal your gross income. Minus selling, general, and administrative expenditures, they call that SG&A, gives your operating income. And then you have other income and expenditures. Then you have the pre-tax income. Then you have your taxes. Then you have your net income after tax. Now, some people use a multi-step format, others use a single-step format. The goal is have a financial statement, have a system that will capture at least your total sales minus the costs, minus your taxes, to give you an indication of the health of your operation. Are you profitable or are you operating on a loss? Always want to see a net income, not a net loss. The second statement is the balance sheet. I call that the body weight. Notice, if you look at the human body, we are in full balance. We have 2 eyes, 2 ears, 2 nostrils. We have 2 hands, 2 legs. Why? Our body needs equilibrium. And it seems that assets equal liability plus stockholders' equity. So the balance sheet is going to tell us what you own should equal to what you owe plus the residual, the capital that remains in that business. But when you look at the balance sheet, it's only a snapshot, is a point in time. The income statement is from the beginning of the fiscal year till the end of the fiscal year. Now, what else do we look at as finance professionals and bankers? We look at your cash flow statement. Yes, you're operating, but are you operating and generating income from operation? Are you generating income from investing, or are you burning money? Are you generating cash through your financing activities, or are you burning that cash? The goal is always to increase your cash from period to period. That's what bankers would like to see, a positive increase in cash, not a negative decrease or a decline. Now, many times you hear bankers or credit professionals asking you for your financial statements, your annual report. Why? Because the financial statements, the annual reports will paint a picture, will tell the creditor or the banker, the one who is going to loan you the money, will tell them a lot about you as a company. Tells you about who you are, your reputation, your character. Were you profitable or not? Are you a risk or not? And so forth. But in the annual report, many times there is some fluff and window dressing. That's why when you read sometimes the chairperson's report, the goal is, are they window dressing or are they telling you the truth? The CEO's report, most CEOs will tell you all the rosy things, but are they also going to tell you the bad things that happened during the year? Auditors report on corporate governance, mission statement, corporate governance, statement of directors, responsibilities, invitation to the company's AGM, financial statements, etc. What I learned when I was in college, my professor used to say, when you read the annual report, read what it's not there, read between the lines. You can construct a story between what they are saying and what the financial statements are showing. Because you can read the annual report now, part of the annual report, you have to look at the financial statements. They might tell you things are rosy, but then when you crunch the numbers, you look at the ratios, you feel there is a gap between what they are saying there and what the statements are really showing. So that's why the bankers want to look at the financial statements and they want to look at the annual report. And sometimes they will say, I need an audited versus unaudited. They prefer audited financials because now third parties are auditing and making sure that everything is in good standing. But is that a foolproof? No. Look, even at the big eights that became big fives, the big fours, for example, as they keep shrinking, even most of them, from Ernst & Young, Cooper Lybrand, et cetera, over the years, every single one of them violated some SECs, violated some rules. They presented financial statements that were not as accurate as they said it is. But it doesn't mean that you cannot get the real story. That's why good financial analysts will weed and will go through all the fluff in an annual report. They will look at the financial statements, and that's why we ask for 3 or more years of financial statements. Because if I want to plot the financial statements, imagine if somebody gave me 1 year, I don't see a trend in 1 year. They gave me 2 years of financial statements. Again, I cannot establish a trend because maybe year 1 was high, year 2 was low. Does it mean it's bad? What if year 3 was up? High, low, high. It could be same, or low, high, low. Now, by having a 4th and a 5th year, now I can create a trend, I can extrapolate. That's why it's important to understand you don't build your credit overnight. That's why startups, small businesses who start today might not be able to find immediate and quick financing because they haven't established that history. They don't have 2, 3, 4 years of finances. Maybe they need co-signers. Maybe they need someone to guarantee, someone with a strong credit standing to be able to guarantee the fledgling new business and so forth. So that's why when we ask for financial statements and we say we need 3 or more, it's not capricious. Financial analysts and credit analysts, they need that information to understand the health of your organization. And many times I used to tell some of my clients and distributors when I work for companies, if you give me your financials, I can actually help you to be in a better health. For example, I had a client in Mexico where they wanted a credit line of $500,000. We said, sorry, I can only give you $10,000 based on your financials. But over a number of years, we're able to take that company from a $10,000 into $700,000 credit limit. But it took some time. We helped them build the strength, a financial strength, reinvesting in their companies and so forth, to the point that now they can stand on their own credit standing and command at least 700,000 credit line as a small company. So that is very important for you to understand. You want to have good financial statements. You don't need to be an accountant. Many small businesses are not accountants. They might be in sales. They were a good salesman. They have a good idea. They decide, great, I was able to sell. I can open my company and I can really make a kill. But that salesperson is not an accountant, is not a finance person. You need to really educate yourselves on some financial lingo, some language. You don't need to be an accountant or a CPA, but understand what's an auditor's report, what's a balance sheet, what an income statement, what's a cash flow statement, and so forth. Understand, let your accountant even educate you on accounting policies. You can Google, you have Wikipedia. There are many websites that can teach you accounting policies and principles at no charge. It's only you need the time to look for that information. Why is cash flow important to a company? We're talking about mastering financial literacy and financial freedom. Because remember, cash is king. And I'm not going to be reading everything on this slide, but just understand, without cash, the company will dissolve, will die. So cash is the blood of that system. Without cash, will get you your raw material, will get you what you need to be manufacturing to be able to sell. Cash will help you hire people. Cash will help you pay your taxes. Cash is really the lifeblood of any business enterprise. So cash is king, remember. Now, methodology. You need to, as a small business owner or even as a Fortune 100 company, you need to have a system and you have to have an analytical and financial approach to financial health. Now, let's start by looking at the income statement. I want to help you now with some understanding and then get strategies as to the different statements, because many times we talk about the income statement. Great. Now, what can I do with that income statement? Again, look at the image here. You have net sales, you have gross income, you have operating income, pre-tax income, net income. So if I look at the income statement, few things jump at me. One, I need to be selling in order to start generating profit. Without sales, there will be no profits. So I need sales, but then I have a series of costs. I need to minimize the costs to be efficient and effective. And then I need to pay my taxes, because many small businesses think, oh, I can defer my taxes. If you don't have a legal and accounting principle to help you defer it, you need to pay your taxes. Because otherwise, if you don't pay your taxes for several years, you could have hefty penalty and you could go out of business. I know a restaurant that failed to pay sales taxes for many years. They are no longer in business, even after 40 years of being in business successfully. The owner died. The wife took over. She didn't know about what the husband was doing and so forth. Without paying sales taxes for many years, they were audited and then they were out of business. So taxes are very important to pay, because once you pay your taxes, after that, the money is yours. That net profit still is not cash, is profit, is yours. Now you need to convert that profit into actual cash. Now, as I mentioned before, when I look at the top line of the income statement, the sales revenue, always net sales equal gross sales minus any discounts, returns, and allowances. If you want to save money, make sure that your net sales always equal your gross sales and no discounts, returns, and allowances have occurred. That will entail really total quality management, process improvements, streamlining, understanding everything in your operation. So, why do people give discounts? Ask yourself. It says a discount is an incentive that the seller offers in exchange for prompt payment. Why would you give someone a discount? To incentivize them. You negotiated a deal, you sold them a product or a service, now they have to pay you. Now, if you did that discount before, that's okay. But if you are giving a discount in top of already a discount that was given to close the sale, then you are losing margin. You are losing part of your profit. Ask yourself, if you have sales returns, why are they occurring? Every sales return should be once, it never to be repeated. Make sure that you study every sale return. An allowance, why are you giving an allowance? Why are your customers sending you debit memos or asking for credit memos? See, sometimes we use those as accounting terms, but beyond the accounting terms, there is a systemic problem. There is maybe an issue, a virus or a bacteria in your system that caused that discount to be given, that return, that allowance, and so forth. Find it and cure the system. You don't want any financial bacteria or viruses in your financial system. When we look at cost of goods sold, for example, do you know that most people can negotiate? Here becomes about becoming a good customer and have good vendors. You might be small, but maybe understand the power of vendor management. Big companies manage their vendors. Take Costco's, the Kirklands of the world, take Walmart, all these big giant and box stores. They negotiate with their vendors. Why? To lower their cost. Don't think because you're a small business, you cannot negotiate. Everything is negotiable. Build good relationship, show them that you really mean business, that you are a good credit, not a risk. And now see if they're willing to work with you for a long-term relationship. So you can actually look at the cost of each item that you purchase. Look at the cost of raw material. Can you find different sources that can give you high quality material? Make sure you don't undercut yourself. Some people will go for cheap material, but you sacrifice quality. The goal in financial security and prosperity is to be able to sell high quality at low cost, retain the goodwill and loyalty of your customers. So practically, when you think of the word of cost of sales, are you able to create relationship with your vendors so they can actually give you a better rate, better discounts, etc., so you can minimize your cost? So again, when we look at net sales minus the cost of goods sold equal your gross income. If you maximize your sales and you minimize your cost, what did you do? You maximize your gross income. Now, selling general administrative expenditures. You need, remember that every time you hear the word expense, you need to realize, is that expense needed? Is it relevant? Will it really help me to be more profitable or less profitable? So you have to really scrutinize every line in your income statement when it comes to cost and expenditures. Many times people buy because they just wanted to buy. Don't buy things because you want them. Buy things because you need them. Again, notice needs, wants, and desires. I've seen people buying vehicles because they desire, let's say, a Rolls-Royce, when they would have been better served if they had just a Kia. It does the same job. But as you grow your income and as you have a surplus, yes, if you want a Rolls-Royce, we're not against a Rolls-Royce, but as you are a small business, are you using your profits to put into things that the business or you as a person don't need but desire and want? If you focus on your needs, you will be in a better position and your business is going to be highly profitable. So now look, just by looking at this section of the income statement, look at the strategies now. Many times we think, oh, income statement, P&L, profit and loss. That's not what really is the purpose. The purpose is to say, when I look at my income statement, the first thing that jumps at me is sales revenue. What helps me to generate revenue is my marketing and sales strategy. Right there, your marketing and promotional mix. So by looking at how do I increase my revenue, my sales revenue, I need to have good customers. I need to have good product. I need to have good sales force. I need to have a great marketing team. I need to have a social marketing strategy. So you see, look at how many strategies come out at you, jump at you just by looking at sales revenue. When you look at cost of goods sold and all the other expenditures, what you look at process improvement. In the 80s and 90s, most companies here in the United States, around the world, they were looking at TQM, total quality management. Now they call it the Toyota processing production systems, Kaizen, Kanban, which means in a simplified form, Six Sigma, Lean Sigma, 2-second lean, etc. All what we are saying, are your operation streamlined? Are you preserving cash? Are you maximizing revenue? Are you maximizing profit? How? Making sure that you are highly organized, you are efficiently run. That means more output from a minimum input, and you are effective. You are hitting all your targets with the right people, the right technology, the right processes, people in the right place, doing the right things, hitting the right metrics, etc., etc. Now, also, when you look at your SG&A and you look at everything that is cost and expense, understand always as a business owner, whether you are small or big, or now maybe when you are small, you are more frugal. As you grow, continue being frugal. Always think of cost reduction. Notice, I didn't say reduce. I don't like to lay off people. If you hire people, keep people. I always tell my clients, always reduce your costs. Keep your people. People, process, and technologies, PPT. Look at the technology, look at the processes, look at the inanimate materials, look at things that are not human. Lastly, you touch your human beings. Don't bother hire people to lay them off later. Whenever you do a hiring decision, make sure that it's going to be for the long term. And that person, remember, it's a human being. You don't want them to be hired today to be let go tomorrow. Do everything you can to make sure that whom you hire today will be with you on the journey to profitability and sustainability and prosperity. So how you do? Always look at your cost, reduce it. Vendor management, supplier management comes by understanding the power of the income statement. Negotiation, negotiation, negotiation. If you want to lower your cost, you need to learn a skill. Negotiation skill is a very important key skill to know as a business owner. Why? Because it will help you to streamline and to lower your cost and maximize your profit. People. What you need to understand about people is have the right person. Don't be distraught to hire the first one that comes through the door. Hire the right person. Take the time before you hire any person. Put them in the right place to do the right thing for you. And you have a person for life, so to speak. Look at your processes. Are they lean? Are they green? Are they quality focused? Look at the technology. Have the right technology. And then understand, when you look at the income statement, there is a section called depreciation. So this is an uncash. Once you spend the money on vehicles and some machines, they depreciate. Now you can lessen your income so you can pay less taxes. Understand all depreciation strategies to maximize your profits. So you see, just by looking at the income statement, look at the different things that you need to be thinking about as a business owner. Now do the same with other income and expenditures. So really what I'm showing you here is a roadmap. Really, this is the tip of the iceberg. We will need months and years just to go over because taxes change. Look at the tax code in the United States, millions of pages over the years they have accumulated. You're not going to be reading millions of pages, but each year you have to understand what taxes affect you as a business. How can you maximize your income by taking really advantage of every legal deduction that you can take as a business, and document that. Read the law, consult with CPAs, tax accountants, even call the IRS. I always recommend, if you are in business, take time to read the tax forms that you need to file. Maybe your accountant files them for you. Take time. Tell your accountant to teach about the tax form. Read the IRS and the franchise tax board. They will give you instruction booklets on every form that you have to file. Read them. And many times at the beginning of every form and every booklet, there are what's new this year. Look at what is new in this year. Many times you'll be surprised. Like if you are self-employed just by yourself, do you know that you could open a solo 401k, for example, and it could help you defer $30,000 for yourself plus a SEP IRA equivalent into that? But you have to be one person, self-employed, no employees. So the key is, there are a lot of tax strategies, tax rules that can help you. Even the IRS says, take the deductions that apply to you, but they're not going to tell you. I discovered several forms the other day that said, wow, you can use those forms and now save more money. The IRS does not, schools don't teach us. The IRS doesn't teach us, doesn't knock at your door as a small business and say, let me tell you what forms you are going to be using. And by the way, you missed these forms. It's up to you as a taxpayer to learn the tax code. So one assignment you want to give yourselves is learn as much as you can about the tax code from year to year. What's applicable? How can I maximize my income? How can I minimize my tax bill? That is legitimate. And the IRS even tells you, take what is coming to you. Don't leave anything on the table, but they're not going to make it easy for us. They don't say, oh, you are ABC business. Guess what? These are the forms you need to file. These are the deductions you need to take. No, the IRS says, you know the law. You read the tax forms, get your accountant, get your CPA, get your tax advisor, and let them help you or you do it. So that's why it's very important to be abreast on all the laws and regulations. Again, look at this slide, another takeaway. Look, we just added the previous slide, a couple of slides, we had 9 strategies to look at. Now we have 10 and 11. You need to look at your extraordinary items and you need to look at the tax issues. Your goals is to maximize deductions and lower your taxes. Now, that was about the balance sheet. It's really amazing. Imagine if you just took a couple of these slides and make them as posters and share with your team and start going. Now you can take one item at a time and create policies and procedures and strategies to increase your sales, minimize your expenditures, maximize your profit. Now look at the balance sheet. The balance sheet is a financial statement that summarizes a company's financial condition as reflected in its assets, liabilities, and shareholders' equity at a specific point in time, which means tomorrow, if I took another snapshot, things could change. Some companies will close, if they are seasonal, will have their closure at where they are the best in their financial status, where their assets are very high, their expenditures very low. But if we took another snapshot a month from then all of a sudden their assets are lower and their expenditures are very high. So that's why the fiscal year is very important for some companies if they are seasonal or they are going to be subject to the economic upturns and downturns. When we look at the balance sheet, you need to educate yourselves. In fact, Harvard has a course says finance for non-financial managers. I've seen accounting for non-accounting managers and so forth. So really, all what you need to understand the lingo. What do we find in the asset section? We have current assets, we have non-current asset, property and plant and equipment, intangible asset, other assets, then you have total assets. Then you have a liability section, current and long-term, then you have the stockholders' equity. And remember, it's a balance sheet. Assets should always equal the liabilities plus the stockholders' equity. Now, when we look at the current asset, what do we look at? Cash. That means anything that is liquid. 360 days or less, you can move it and becomes total liquid. It goes into current. Anything that cannot, like a CD of deposit that is 3 years for maturity, that's not current, that's not liquid. It cannot be converted to cash within the operating cycle or within 1 year. Cash, petty cash, short-term marketable securities, 60-day securities, 90-day securities, short-term accounts receivable. Think about it. If you are giving your customers net 370 days, that's not current because a year is only 365 days. And also, how can a company function on receivables that are more than the normal operating terms? Most companies have 7 days, 15 days, 30 days, 45, 60. I don't recommend beyond that, but some will go 90, 120. You have to be special kind of a company to afford that cash flow cycle, to wait for your money for more than 60 days. For a small business, I recommend cash and carry, so to speak. If anything, no more than 30 days. But many times when I'm dealing with big companies, they want to impose on you 60 days, 90 days. Negotiate those terms because I believe small businesses cannot afford to wait 60 days or even more than 31 days. You need your money. We have to be compassionate as a business sector. We need to make sure that the small business grows. The way they're going to grow, keep that blood flowing, give them the cash flow. 30 days or less is doable. But beyond that, now, if you are accepting or giving terms beyond 30 days, make sure you have a reserve that allows you as a company to stay in business for many months should there be a hold on that payment or the company doesn't pay you within those terms. Because sometimes 60 days become 90, become 120, become 150. Can you stay in business that long if all your customers, you are giving them those net terms? You look at inventory. You want inventory that is not obsolete, inventory that is going to be turning fast so you can generate income. Supplies, practically they are sunk. You use them So prepaid expenditures, that's done. So really, when I look at current assets, I look at cash. I look at things that accounts receivable and inventory management. So now, when you think of cash, you'll be surprised. Many people think cash. Oh, if I get the green buck is cash. Wait a minute. Cash could be forged. Many years ago, I was in South America. I had a $100 bill. I was going to pay for a visa for my wife. The officer said, no, sorry, I cannot accept this $100 bill. I said, I just got it from my bank in the United States. Says, sorry, it's the A series. I said, what's the A series? Oh, these are series of money coming out of Colombia. Oh, drug. I said, but that's not drug money. No, A series. I said, okay, I didn't have a credit card at that moment that I can use with me ready. So I took another $100 bill, says, again, that's the F series, I won't accept it. Funny is, I got another one, okay, yeah, that is good, I can accept it. But when I went to the hotel, it was okay. The hotel accepted both of my, but at the airport, they will not accept the cash. So again, think again, is cash always cash? Not necessarily if it's not accepted by the other person. So you see, these are, when you think of cash, think of internal controls, separate duties between those who receive it, record it, and disperse it. When you get cash as a company or checks, deposit the same day of receipt. I've seen companies and clients of mine, they receive checks and they sit on it for several days. Imagine, that's risky. Cash deposit same day, check deposits. The moment you receive the cash or the check, deposit in the bank. Because many times a check out of the country takes several days or weeks. Within even different states could take more than 24 hours, even though we have check 21, it should cash within 24 hours. Still, the bank will not put that money in your account immediately. It could take a day or two before that money is in your bank account. ACHs. I had a client ACH me some money. It took 4 days before it hit my bank account. So in essence, cash is not cash unless it's in your bank and the bank tells you, yes, this is the balance in your checking account that you have. Then the cash is in your account. So when you think of cash, have checks and balances, checks and controls. Again, accounts receivable. The two things I want to teach about, I can talk days on that. I love accounts receivable management. I worked as a collector, international collector for many years. The quality of your receivable, that means the quality of your customers. If you have good credit, qualified customers, you are going to get paid on time. But if you just sell to anyone because you just want to sell, you might not get paid when the money is due. So again, inventory is part of current assets. Remember, your raw material, finished goods, work in process are part of inventory, but they are not saleable. They are available for sale, the finished goods. Raw material has to go into the processing, into the work in process, into finished goods. So in essence, make sure that your inventory is always relevant, does not become obsolete, and always you might lose sale. Remember the top line of the income statement, sales revenue. You can increase that sales revenue if you have inventory. Make sure that your reorder point is timely, because many people lose the opportunity of selling because they don't have things on the shelf. A good example, during the pandemic, my wife and I wanted an item. We always used to go to Costco. We will go to Costco. First, there were long lines. Then when we arrived in, there was nothing on the shelf. So that afternoon, we decided, let's go to Smart & Final. We rarely went there. We found it in Smart & Final. Guess what happens? During the pandemic, the first thing we did, we always went to Smart & Final instead of Costco. Wow. Look how much Costco lost because me as a consumer went to Costco, nothing on the shelves because they didn't reorder it on time for me to see it on the shelf to buy it. For a consumer is, if I don't see it, doesn't exist, I need it, I have to go find it somewhere else. So that's very important in your inventory management. Always have the inventory available for the customers so they don't go somewhere else. Bottleneck enhancement, outsourcing, etc. So again, that's a whole presentation on inventory management and so forth. But I need it as a business owner, you need to understand that. Also in the balance sheet, you have fixed assets, land, building, equipment, furniture, accumulated depreciation. You need to educate yourselves on capital expenditures. the routine maintenance that is required, ordinary repair whenever you have buildings, equipment, and so forth. Not just buying a piece of equipment and that's it. There is repair, ordinary repair, extraordinary repair, breakdowns, etc., replacement, additions. You see, a small business owner might not think about that. Oh yeah, I can buy a car or a vehicle for the company, but a vehicle is one thing. The payment on the vehicle, repairing the vehicle, registration of the vehicle, insurance on the vehicle, etc., etc. The next thing, now look at the other side of the income of the balance sheet, liabilities. Again, the assets tell you what you have, what you own. Liabilities now what I owe to others. Accounts payable. I want to teach you two things. Pay your bills on time, protect your reputation. Never, never, never go by the adage. It says, pay as late as possible, receive as early as possible. No. Pay according to the terms agreed or even before. And receive according to your terms or before. That is what makes good business sense and builds your reputation. When I receive a bill, I pay it immediately. I don't even wait to the due date. If I receive the bill, I owe it and I have money, I'll pay it. Some people said, no, milk it. No, because sometimes people try to milk it, use that money to make more interest, to default on a vendor. What happens? When you default on a vendor, your reputation is going to suffer. When that reputation suffers, you're not going to get the discounts, the allowances from that vendor. All of a sudden, you start losing money and losing reputation. To me, reputation is very, very prized. Reputation equals money in the bank. It will save you money if you have great reputation. Again, when we look at balance sheet, I look current assets and liabilities. Many times, financial analysts will look at your working capital. They take your current assets minus your current liabilities. Also, learn what it means, the operating cycle. That means what's your DSO? That means the time to turn your receivable, and the DIO. That means days inventory outstanding. That's your operating cycle. I had cash, bought inventory. Now my inventory was this much, how many days, and then I sold it. I waited this much days before I got paid. But your cash conversion cycle is very tricky. Imagine you spend the cash to get inventory. Your inventory took 30 days to stay on the shelf. You sold it. It took another 50 days to get paid. That's total of 80 days. But lo and behold, your creditor said, by the way, you owe me money. Your terms are 60 days. Now you have to pay them. Now your cash conversion cycle, now you need 20 days of cash. That's why you want to have a minus. You don't have a plus. Anytime you see a plus, it means now you need discretionary practically, or you need somebody to give you a loan or to have retained cash somewhere so you can have that gap bridged with your own cash, with any loan, because you will not get paid from your customers for another 20 days. So you see, a lot of small businesses don't understand. They say, I just sold it and I'll wait. Don't wait. Make sure that you always receive the money, if possible, before you owe someone. Now you are in negative cash conversion cycle. This is wonderful. It's like when people go to McDonald's. You pay cash, you get the item. Now you have cash to pay your accounts payable on time and build that reputation. So as a business owner, as a small business, understand the power of working capital, operating cycles, and the cash conversion cycle. Again, in the balance sheet, we have a section called stockholders' equity. So what do we do here? We're going to look at what's the residual. That means I own a lot of things. I have a lot of assets. Yes, I have loans and liabilities, but when I take all what I owe, now I have remaining capital. I have retained earnings. I have money that I can put aside if there is a legal case against me, if there will be a contractual agreement in the future, financial planning, future to cover future losses, lawsuit, etc., etc. That is really a healthy mindset. Maximize your stockholders or owners equity section. Build your assets, minimize your liabilities. Since they equal what happens to your stockholders equity, there is no direction but up. It will increase. The cash flow statement. Again, there are many books. You can Google Investopedia and others. They have amazing sections to educate you on what is cash flow from operating activities, investing, and financing activities. Now, you see, so far we started by, you have to be individually sound. Now, as a business, you need to be building your business on sure fundamentals and great foundation by understanding the power of your income statement and all the strategies that can help you maximize your revenues and maximize your profit and minimize your expenditures. We understand the power of the balance sheet to create balance in your life, maximize your stockholders' equity, and also understand the power of cash flow, positive cash. Now, here's a skill I like to share with all of you is the secret of effective collections. I love collections. I worked in collection agencies. I did collections from around the world, talked to distributors from Germany to all of Scandinavia, Japan, China, around the globe, throughout Latin America, the Middle East. And I found something unique: communication, communication, communication. Understand the power of communication. That's why we say connect to collect. If you communicate, connect with your customers, they will pay you with respect and with a smile. So now let's share a very interesting chart here. Here is a trick question. When I ask people, when does collection start? Many people go to, look at the chart. They go to the fourth step, collection efforts. Wrong. Collection started way before that. It started with the sales and marketing efforts, because sales and marketing, your salespeople are key component of your collection activity. They help you build the prospect desire and willingness to buy the company's products. Then credit due diligence will say, yes, that customer has good ability and willingness to pay me. Then customer service comes to be the bonding agent to preserve, protect, and maintain the cash flow. And then the collection effort help you convert the willingness and ability to cash. So notice, if your sales and marketing strategy, building great relationship with customer, your credit due diligence is really amazing, and your risk mitigation techniques are top-notch, your customer service is really delighting your customer, AAA rating, now all of a sudden, your collection effort is easy. They're happy, they're willing, they'll pay you with a smile. Now, let's focus on our collection efforts. This is mind-boggling. $1 today, in 2 years becomes 10 cents. Imagine if you sold, or you are really lending someone $1, that dollar become 10 cents. Imagine $1,000 becoming only $100. But notice, in 3 months, that dollar became 73 cents. In 6 months, 50 cents. In 1 year, 25 cents, which means the longer you wait, the less the value of your money, because now they might go out of business, they might default, they might not pay you. Time is money, Benjamin Franklin said. So connectivity is the road to productivity. So when you think of collection, I want you to think in terms, it's a process, it's an event, it's a cycle, because imagine you're aging, it's called aging report, it's aging. So that means your collection is on a daily cycle. You don't say, oh, let me wait a month. No, you have to collect daily to make sure that everyone stays current, no one goes past due. It's an art. It's not a science. Yes, there is a scientific method to collection, but it's more of an art, because you are dealing with people that are moody, people that have, they are subject to the environment, to changes within themselves and outside environment change them. The economic condition, the economic shocks. To me, collection is fun, is magic. But guess what? Collection is about follow up and follow through. If you don't follow up with your customer, follow through on your promises and on their promises, nothing will happen. Again, collection management requires a balancing act, a behavioral and psychological approach to motivate, a sociological approach, an anthropological approach to migrate and link, a customer service approach, a systematic procedural approach. I call that the SPA. But the SPA is really the discipline of helping them to pay you on time, an emphasis on the positive. That means in attitude, tone, and approach, the mastery of bargaining and negotiating techniques. Your strategy when you are dealing with collection should be really on open communication, teamwork, strategic alliance, setting milestones, being proactive, using the SPA, this is a systematic procedural approach, and having good and comprehensive credit policy. We can speak days just on this slide because each bullet point it has a host of subpoints that we can really talk about. But I want to give you right now the tip of the iceberg, the 30,000 foot view. Is like, I want to zero in on having really a systematic procedure approach. Have a system, have a policy, let your customers know your system and policy. It will help you collect on time, because don't make it mysterious, make it visible. If I sell you today my terms on 30, tell them exactly what do you mean by net 30. Net 30 from invoice date, not net 30 from you receiving my invoice, or not 30 from whenever you decide to pay me. Net 30 is from the date of the invoice. Be predictable, create consistency. There are tactical approach. There are 6 tactical lines of defense: invoicing and mailing on time, involving a field blitz through your sales team, using the phone, a combination approach between salespeople calling and sending mailings and sending a statement, a second invoice, then put the account on hold. It's not to discipline, but to educate and to show them that there are some constraints now in order to make sure that we get paid to continue the relationship. And lastly, third parties, that means collection agencies, collection attorneys, etc. Invoicing and mailing, one word: timely. If you sell today, invoice today. Every month, send a statement. Make it predictable so they know exactly the date of the month that they will be receiving to get paid on the 1st or whatever due date it is. Field blitz. Many companies don't realize that they have a very powerful collection team, your sales force. Remember, Salesforce have relationships with procurement managers, with people in that company that maybe the collector might not have access to. Involve everyone. And who is the top salesman of the company? Guess what? Everyone is a salesman in the company, from the receptionist to the CEO of the company to the members of the board. When I have a tough collection case, I will invoke anyone in the company who knows someone in that company that can help me get paid. So practically, when I think of the sales force, we are all involved in sales. We are all involved in customer service. The phone is amazing. You know, it's a quick connection. Use it. Many people don't like the phone. One of the most important tools in collection is the phone. When you want to call someone, make sure before you make the call, be prepared, but make the call, conclude the call, follow up, post-call follow-up, and then have great listening skills. The combination approach. Many times, think about it. If you call someone, send them a quick email to thank them and remind them, and send them a statement. Wow, now they heard you, they are seeing. You are involving the eyes, they are involving the ears. And when they receive a mailing, the tactile, because there are 3 learning approaches. Even there is a 4th, through gut feeling. But if you involve more senses, your chance of collection will go high. The hold mechanism. Sometimes you tell a customer, sorry, I cannot continue to sell. I need my money. Third parties. There is a time to say enough is enough. We need to go through legal action. We need to send you to collection agency, but don't threaten unless you really mean it. Now, tactical collection approach. The first thing you want to know is when you have a portfolio of customers, classify them as to their character, to their reputation, to their payment habit. Some are special cases, work with them, but some have excuses, others have reasons. Classify those with excuses, classify those with reasons. Tactical approach. Always go after the person who's willing and able. They are great to have. They will pay you on time. Those able and unwilling, pursue vigorously, send to third-party involvement. Those who are willing but unable, work with them, put them on a payment plan. Unable and unwilling, write them off. It's a waste of your time and your resources. Classify your customer as those who are prompt, those who pay 31 to 60, 61 to 90, 1 to 30, etc. Which means that's why a very important tool for a collector is the aging report. Are you using it? Make sure that everybody is always between the 1 to 30, never above it. I love to have most aging, nothing in the 31 plus. Again, tactical collection approach. Their customers send their check, they put a stop payment, or they don't have money. Some chronic complainers, trap setters, naggers, promise breakers, fraudsters, shysters, deadbeat skips. Understand these special cases. And then excuses. Oh, the check is in the mail, did not receive the invoice, pay only from statement, pay on the 10th day, etc. If an excuse, eliminate. But what are the reasons? Cash flow issues, going bankrupt, divorce issues, bank close, line of credit, currency devaluation, financial difficulty, wars, upheaval, tsunamis, typhoons, hurricanes, tornadoes, all of that. Those I can work with. But excuses, eliminate immediately. So determine if it's an excuse, eliminate it, create a sense of urgency, anticipate the next excuse, eliminate it, think ahead of the debtor. Remember, debtors will have emotional responses. They must be acknowledged. How to deal with excuses? They are legitimate. Work with them. Never browbeat a customer because they have a real reason. Work with them. You win their loyalty and goodwill. But if an excuse, call their bluff, and they will respect you for it. So again, remember the word cash flow? Cash, C for contact, A, attentive focus, S, systematic and sympathetic, H, heart, humble and honest, F, friendliness, L, liberation, O, open-mindedness, look at the options, always think both of you are winners. It's not just a buyer and seller, you have a relationship. Make sure that even though they owe you money, they end up winners and you end up a winner too. Have a system. Some systems like have a daily activity report, particular file, past due invoice, ledger cards, notes, calendars, Outlook calendar, to-do list, aging reports, DSO reports, potential write-off reports. Again, have a system for your collection efforts. Here is an example of what you do in collection. Day 1, I do this. Day 11, day 20, day 45, day 90, turn account to a third party collection agency. We used to do that 1, 2, 3 with one of my clients. 30 days, 60, by 90 days, it goes outside. It cleans the aging and it teaches your client to pay you on time according to your terms and conditions. The 80-20 rule. You'll be surprised. 20 of your portfolio is giving you 80% results. And 80% of the customers will only give you 20% results. Put 80% of your efforts on the 20% of the portfolio that will give you 80% results. And put 20% of your efforts on 80% of your portfolio that gives you 20% result. But when I mean 20% effort, but each time you touch an account because it's small, you give them 100% attention, but 20% of your time. You see, attention and time is two different things. If you're on the phone with anyone, whether they owe you $1 or $1 million, same respect, same policies and procedure, same education, but those who owe you $1 will be quicker than those who owe you $1 million. Follow up, follow up, follow up, and follow through. That is the secret of getting paid on time. Again, the KR factor, which means knowledge and relationship factor. Call overdue accounts early and frequently, be consistent with invoice and statement, update payments regularly, train properly. Yes, train your people, train your customers, rectify billing errors quickly. Not every account is collectible. Use third parties when necessary. Use the technology wisely. Build relationships. This is very, very important because when you are a human being dealing with high respect with another human being, sympathy, compassion will get you paid on time. Learn and master the diffuse technique. When you think that the customer is heated, he's like a pressure cooker, don't open the lid. It will blow in your face. The first thing is don't allow yourself to lose your cool. Encourage your customer to vent their anger, open the valve, let the steam come out. Now find out the facts. They're emotional. By asking questions, you move them to the logical state. Understand their feelings. Now tell them, yes, I heard you, understand you, I feel. I feel that empathy. Suggest a solution, end on a positive note. Final thoughts. The ABCs of collection is acquire knowledge. Knowledge is power. Be a builder, builder of rapport, builder of relationship, be a friend. Checks and controls equal constant monitoring. It's like your dashboard, having the tools, the aging reports, the different reports, the to-do list that can help you, the daily activity reports to have your checks and balances. D for due diligence. It makes the difference. E, empathy times expertise equals excellence. F, follow up, and follow through. Follow these fundamentals, they shall lead you to your goal. The G is your goal. Your goal is to find ultimate and most precious cash that will secure your timely cash flow. So that's, again, the ABCs brought you to the C of cash flow. And the 4 Ps of collection. There is a contradiction here, but it is not. Be patient and persistent. Be proactive, but be prompt. See, you're patient, but you have to be prompt. You're persistent, but you are going to be prompt. That means act quickly in a timely manner. Be proactive so you don't have to really be running after the money. If you proactively train your customer on your policies and procedures, then you are going to be extremely ahead of the game. And if they owe you money, let them come before the due date so you can move the date into the future with adding some interest to become a finance institution, so to speak. I've done that before. Always be persistent and patient. Be passionate for your cash flow process. In fact, Kenny Rogers in The Gambler said, you've got to know when to hold them, know when to fold them, know when to walk away, and know when to run. Yes, in collection sometimes, remember the AW matrix, the ability and willingness. If a customer doesn't have the money or wherewithal and you know they're bankrupt and insolvent, it's time to fold them. That's it. Run sometimes from a deal that is going to be bad. Walk away from a bad negotiation. So in essence, sometimes you can hold on to the good customers with the reasons, fold them when they are totally bad, run away and walk away. That's okay. You can do that. But I've seen a lot of companies and collectors, they keep the bad debt on the books forever. What happens to it demoralizes the collector, it moralizes those who look at that bad debt every day. Bad debt is bad debt. Clean it, write it off, take a tax deduction, and move forward. Grant Hill said, treat people with respect and be honorable human being, and you'll end up a winner. And that's the secret of success in any collection, any business. Businesses deal with other people that have needs to be fulfilled, that have problems to be solved, that have pains to be alleviated. We're not dealing B2B, building to building. When we talk about business to business, really we're talking about person to person. People talk to people, they make things happen. In God we trust, all others pay cash. There is an Arab proverb that says, trust in Allah, but tie your camel. That is fascinating. So that means in collection and in any relationship, there is trust, but also there is constraint until you really know the other person. So this is amazing. We were able to finish. And as today, we did the 5th webinar. And on June the 18th, as you see in this slide, the City of Glendale has prepared another webinar. I will be conducting this for you, the fine art of credit management. This will be amazing. I'll teach about the C's of credit. There are actually 22 C's of credit. Bankers talk about 5 C's, but I will expand it to 19 C's of domestic credit and 22 C's of international credit. And we'll talk about it next time. So I want to thank you very much. If you haven't already listened to the previous webinars, here are the recorded webinars, including today. Notice from time management, effective negotiation, to a customer service approach, cash flow management with a twist, and today, mastering financial literacy. And on June 18, we'll be doing the 6th webinar in the series. Again, the City of Glendale Economic Development Division will thank you very much for being with us, and we'll thank in advance all those who will be listening to the recording. So I think we have a few minutes. If you have any questions, feel free, unmute yourselves, and I'll be happy to share some of my thoughts and ideas with you. And if you think of any other question in the future, feel free, send an email to Mariah or to the City of Glendale Economic Development Division, and they'll forward to me. I'll be happy to contact you with answers and with my thoughts about any question that you might have. So if you don't have any questions, since we have a few more minutes, again, the importance of cash flow management and the importance of today's webinar, Mastering Financial Literacy, is that as a person and as a company, you are as strong as the strength of your cash flow. If you have the cash, you can stay in business. If you don't have the cash, your business will suffer. So one thing I highly recommend that you as a small business owner have reserves that will help you to withstand any economic shocks. During the pandemic, the government was able to give the small business the PPP, the payroll protection payments, the program that they had cities and states and the federal government, they had grants. But always think, what if there is no grants and programs? You should be able to self-insure yourself through your mastery of this skill, financial literacy and financial discipline, financial freedom. If you build that skill, you become your own savior, so to speak. You have enough reserves to keep you going in any economic landscape. So good money mastery will help you to create the stabilizers through any upheaval in the economic landscape. So it depends on you as a small business owner. The more you learn, the more you hone, the more skills you have, you're better off. So with that, thank you very much. And if no more questions, I'll stay for another 2 minutes and then we can stop the recording.